Let's consider job costing, the topic of job costing, and how it relates to our case study, the Eastern Shore Milky Way Company. Job costing, as opposed to or rather than process costing, is done when a company is selling large, unique, or expensive products. And of course, a space vacation that many of you are computing a sale price of about $10 million on would qualify. So, very often, the management accountant will prepare a job cost sheet, and I'm going ahead and, as I did in the case study, and showing the sheet already prepared. So you really aren't going to have to do anything more in this class than put these items in the right place if I give them to you, or use items that were given. So here, notice the case study was worded a little bit differently, but you'd have to pull these off and put them on the job cost sheet. So we have direct materials, which in our example are only food. And so we're looking at, if you remember, or if you've got your case study beside you, I've given you the job cost sheet information for 3 travelers, and Bill David was one. So we said that Bill David used up $1,000 in food. And I'll tell you, by itself, that means he ate more than the average person, because I think we showed a average direct cost for food at $630. Connor used direct labor of $4,000. And what this means is, for purposes of this part of the case study, I treated direct labor as a variable expense. And that means that they actually use time tickets or something to figure out how much labor every astronaut, every food service person, and so on spent on each person. So then we had incurred overhead, and incurred overhead is stuff where we really can't necessarily treat it as a direct cost, and yet we can actually figure out how much we want to apply to a particular person. So the day excursion, for example, for Bill David is $320,000. Let me give you an example of a person who doesn't go. Maybe they don't go on the day excursion because they're space sick or something like this. Well, their number here would be 0. Bill David used his climate suit some, but obviously if you looked at the price of the climate suits, didn't wear one out. So the job cost sheet shows that we incurred overhead of $7,200 related to Bill David, and there was no insurance claim related to Bill David. So the total incurred overhead was $327,200. But then we had to allocate overhead to him. And when we allocated overhead, we allocated $6,658,760. Now recalculate this on your own, but I think that I made an error here, because I think when I came up with this bottom number, $6,986,520, I don't think I added in the direct materials of $1,000 or the direct labor of $4,000. So if you add those in, I think they come up to $6,991,520. Now, I'm going to take the next few slides and show you how I got $6,658,760 as allocated overhead for Bill David. It's one of the more important parts of job costing. We used the predetermined overhead rate, and I want to tell you, predetermined overhead rate is always something I test pretty heavily in Accounting 212. So you do have to know this. And I used it here. To get the predetermined overhead rate, we add up the items allocated but not directly incurred. And what we mean here is these are the things that are not on the job cost sheet. So we don't have any direct labor, don't have any direct materials. Those things are not overhead. We also don't have any overhead that we could specifically show as incurred, like, for example, the day trip and the climate suits and so on. But the other 5 items that showed up in the case study and did not show up as incurred overhead are things we're going to add up here. So we have the annual cost of the ship, which I'm showing as $400 million. Remember, many of you did something different, but for me it was $4 billion divided by 10 years. I couldn't come up with any different hotel annual cost. It was just $1,350 million. The maintenance, for purposes of this part, it didn't really matter if it was fixed or variable. It's $80 million a year. The devices are $150,000 a year. The furniture, $1 million a year. So this means that for all 250 passengers, the total overhead which needs to be allocated is $1,831,150,000. So the predetermined overhead rate says take that, it's computed by, or it says take total overhead to be allocated and divide it by the base, by the activity base. This is just a shade peculiar, but it works. It's a shade peculiar from what the book shows you. So I've taken the only number I have, which is direct labor spent annually of $1,100,000. So I took a dollar figure. A lot of times you're given a figure in hours or units in the class. So in this case, I took the $1,831,150,000 total to allocate. I divided it by the total direct labor hours, 1,100,000, and this got me an allocation per dollar of direct labor. So for every dollar that I spent on a particular passenger in labor, in direct labor, I'm going to apply $1,664.69 as allocated overhead. And here's that number that you saw a few pages ago on the case study, or I should say on the video. I've got 4,000 direct labor hours times $1,664.69 per direct labor hour is $6,658,760 of overhead. So recognize here that the other passengers will have different numbers. The number will have the same overhead applied per dollar of 1,664.69, but their direct labor dollars will be different. So in summary, we can think of some things based on doing this job costing. First, if we priced the flight at $10 billion, which is around where many of you priced it, we were profitable if we only allocated and incurred $7 million of costs related to this passenger. But were we profitable as a company or just for this passenger? We don't know yet. We need to now do the job costing for David Connor, for Connor Bill, and if this were a real enterprise, for all the rest of the 247 passengers, and figure out one by one whether the costs exceeded $10 million per passenger or not. Once we have that data, we can do remarkable things with it. We can decide, are we charging too much? Are we charging too little? As you can tell, I think, this will be the type of business that at first can probably charge whatever it wants and get some passengers because nobody's doing it. But if we're high priced and people could get a lower price for their trips, we might lose all of our passengers quickly. On the other hand, we don't want to lose money. So this is priced, it might be priced too low. If it's priced too low, this job costing will tell us to increase the prices. But another more important thing that I'll leave you to the marketing professor, the economics professor, and so on, is should we consider charging different prices to different people? For example, should we have a low price that doesn't include the day excursion? Should we have a high price that does? Should we not even announce a price until the person travels? And then if they give us a big insurance claim, we jack the price up on them. Well, these are questions that we can't answer in this problem, but they are things that management accounting can help us answer, and particularly job costing within management accounting. Take care. Let me know if you have any questions about the topic.